So have you been a little creative this year with your salary packaging in an effort to hold on to your team? Perhaps you've given them a car, paid for relocation costs, thrown a Christmas party, paid for a gym membership. This is great for boosting morale and showing appreciation, but when you discover it's going to cost you a lot more in fringe benefits tax, it can come as a real shock. In this video, I'm going to explain what fringe benefits tax is and how fringe benefits tax works. And if you stay till the end of the video, I have a couple of bonus tips around what constitutes a fringe benefit and what we can do to reduce fringe benefits tax. Right, let's get into it. Fringe benefits tax. Simply put, fringe benefits tax is a tax paid by employers on certain non-cash benefits provided to employees. It is paid on items provided over and above their cash salary. Fringe benefits tax was first introduced on 1 July 1986 by the then Labour government led by Bob Hawke. It completely redefined how non-cash benefits were treated for tax purposes, especially around areas such as entertainment. At the time it was introduced, it was intended to address the perceived failing in the tax law, which basically meant that non-cash benefits went untaxed, according to the Labour government of the day, causing a tax leakage, which in other words meant they thought they were losing money. In fact, the then government was so upset about the thought of losing tax revenue that they made the tax applicable to employees and their associates. So the next question has to be, what is an employee for fringe benefits tax purposes? Well, you have employees as we all understand them, that is, the people who work for you. But the definition goes on to include people who used to work for you and people who are going to work for you. So think the person who has signed their contract of employment, but they haven't actually started work yet. It also includes beneficiaries of trusts where they are active in the business, directors, office holders such as company secretaries, and people receiving compensation payments, plus their associates. So this means their spouse or their children. It's a pretty broad definition, and the reason for this is because fringe benefits tax is paid on items provided in respect of employment, which in itself is a pretty broad definition and explains why past employees and future employees are caught in the fringe benefits tax net. This can be a pretty bitter pill to swallow, so the good news for employees here is that you don't actually pay the tax, your employer does. As an employee, you will be given the total dollar value of all the fringe benefits you have been provided in a year on your income statement at the end of the year, assuming you've received $2,000 or more in fringe benefits items. This does need to be included on your tax return, but for most of you, it ends there. Whilst the amount of fringe benefits tax is not taxed at an employee level, it is included in certain other calculations in your tax return, such as the negative gearing on an investment property. It will act to reduce the loss. It's not so simple if you are an employer. Firstly, you can't just take the total dollar value of the fringe benefits items you have provided and put that onto the income statement. The total value of the benefit needs to be grossed up to represent the value of the benefit as if it were a pre-tax cash salary. The tax itself is then calculated at 47% of the total grossed up value. That is, they assume the highest marginal tax rate, including Medicare levy. The fringe benefits tax year runs from 1 April to 31 March each year, and the returns are due for lodgement around about 15 May. So there's the bare bones of fringe benefits tax. Now, I know I said that I had a couple of bonus tips for you at the end of the video if you hung around. However, before we get to that, if you've learned one useful thing in this video, perhaps you could consider heading over and just giving it a thumbs up. If you've learned two useful things in this video, perhaps you would consider hitting the subscribe button and supporting small channels like this one to continue to make useful content for you. Right, now that's out of the way, bonus tip number 1. What exactly constitute an item for fringe benefits tax purposes? Broadly speaking, fringe benefits can be divided into 9 different categories, and these are car, loan and debt waiver, expense, housing, living away from home allowances, airline transport, board, entertainment, and residual benefits. Items that are excluded from the fringe benefits tax net include salary and wages, remote area housing, superannuation, minor benefits, so that's generally speaking things under $300, work-related items such as tools, briefcases, mobile phones and laptops, and other digital items. My second bonus tips are around how to reduce fringe benefits tax. If you're an employee, you have 3 main options to consider. Number 1, cash out your benefit. This means receiving cash rather than the benefit being offered. Number 2, make contributions towards the running cost of the benefit being provided. So for example, if you have a car, you might consider making a contribution to the running cost of the car from your after-tax salary. This will help to reduce the fringe benefits tax on that car. And number 3, change things up a bit. Swap out the items that are incurring fringe benefits tax for items that are on the exempt list. If you are an employer, you can use the same 3 options. You can also consider using things like employee share plans or additional contributions into superannuation. So there we go, fringe benefits tax in a nutshell. Thank you so much for watching. I will leave you with this video to watch next, and I will catch you in the next one.